Hi everyone, this is Ben with the It's All in the Reflexes newsletter. Thank you guys for tuning in and for subscribing to the content and sharing your feedback and input and questions along the way. It's just been a great help to me. We had a subscriber call on Friday, and it's our most heavily attended. Really happy to see the participation that we had and the great questions during the call. Unfortunately, my video conferencing software and the platform that I was using for recording didn't work well together, and the audio did not make it into the recording. So I'm going to go through the content that we looked at on Friday, hopefully in a more condensed format, and then post this separately. If there are questions from anybody seeing it for the first time, please feel free to reach out to me, and I'll be happy to clear those up. If there are feedback and suggestions, I'm always open to that. And going forward, we'll probably do the subscriber calls on a new platform, just so that we don't run into the issue on future calls. And then I'll break this one up probably into about 3 sections. So we'll look at in this section, we'll look at the market timing signals and why those are important right now. And then I'll do another section on another video on what we would look for confirmation that we're clear for reentry, or that the risk signals have are no longer active, and then we'll do a separate video on some things that I see with the VIX right now that are unique over the last 10 to 15 years, that confirm some of what we're seeing on these risk signals that we'll go through here. And then I'll probably do a separate one to touch on some of what we see in the crypto space over the weekend. But to get started, let's go through the timing signals. If anybody's interested in following work, if you like the work that you see here, I'm on Substack. I think that's how most people have found me. I also post regularly on X, just because it's easy, and I can put charts out there pretty quickly. So if you're interested in following on any of those spaces, you'll see my content pretty quickly on X, and I do the more detailed work on Substack. You can find me in a couple of Facebook groups and on investing, and but for the most part, you'll see me in these spaces if you follow. So I'm using 10 different signals for market timing to help us identify reversals or near and short-term opportunities. And so this is a weight of evidence approach, looking at the 10 of these. This is probably the most negative that I've seen them in a long time. And currently we would only consider one of these to be green, and that's the Fisher and Coppock signal in the middle. And so we'll go through each of these and what we're seeing. The first one is the most important to me. That's based on the work of Andrew Thrasher, and he won the Dow Award for this in 2013. And so that's our strongest, or my strongest signal for market timing that I follow, and the others are more of supporting and confirmational. But the reason that this top one is so important to me is because it has preceded some of the absolute worst drawdowns in the market. We get a false positive about half of the time, but what we'll see when we go through the charts is if we manage our risk properly and follow a trend, even when we take precautionary measures during an alert that later turns out to be a false positive, we can either maneuver that at a neutral to 1 to 2% opportunity loss by protecting wealth during the alert. And so I'm content to take a neutral to slight opportunity loss to protect myself from some of the worst drawdowns that we've seen. So that's why I think this one's very important. So a few quotes that I like to start off with. I call my newsletter "It's All in the Reflexes" because I want to react to things that I see in the market as if with reflex. But we don't do that just by by being reactive or panicky or jumpy. This is about preparation and the work that we do before we see a signal or a downturn. So we want to make a plan ahead of time, and then we stick to the plan when I do. When the event arises, stick to the plan, and if the plan needs to change, I'd like to do that after. Revisit lessons learned, tweak it, hone it in, and get better at each step. But the way that we'll win in a market turn or transition is to be prepared ahead of time and already know what moves we need to make when it gets here. There's a great book that I'm very early into, but Shocks, Crisis, and False Alarms, and how to assess the macroeconomic risk. I highly recommend it. What we find is a couple of quotes in this one. Another one is that models that we use fail when we need them most, and the flaws that we have in data models are exposed when we have the most extreme data hit them, and so we want to be able to have use models that allow us to use our judgment as well, so that they're not entirely mechanical. We want them mechanical enough to avoid emotions making us do things that are irrational, but we also want to have some flexibility for judgment, because we expect that these things will have a shelf life over time and become ineffective, and that they'll always be presented with a scenario that's somewhat unique. So we're not seeking absolute truth. We want to get as close as we can in a way that lets us use our judgment. And then finally, anytime we get to a transition in the market, the question is this going to be a false alarm in the signals that we see, or is it going to be a massive drawdown? Are we walking into something that'll trigger a recession, or is it a corrective action in the market? We really don't know until we get through it. So we want to be able to take the signals that we see, take the action that we'd planned on, and then we want to be able to interpret the message of the market as trend plays out. It's we've got doubt and we've got uncertainty, but it would be absurd to expect that we would not have that we would have certainty in an environment like the stock market. And then looking at a post from Brian Shannon, I use anchored volume weighted average price quite a bit. I learned it from Brian's work. I use it a bit differently than he does, but he's absolutely excellent, and he's the master at that technique. And he's just got a really direct approach to the market. He's big on the 5-day simple moving average, and he wants to see that pointed upward. He wants to enter things on strength, and at the end of the day, a simple process is a process that's going to work. It's going to be repeatable. So now, when we're talking about an expectation of seeing a bounce or a move up, we want to wait for confirmation that we're reclaiming the trend and the trend is repaired, and these questions are important right now, because what we'll see is a little bit of good news will come out. Buyers will step back in to a market that's corrected a little bit, and what we want to ask ourselves is this a near-term short squeeze, or is the market really recovering? And when we talk about Elliott wave pattern, things don't move in a straight line in markets. They take a stair-step approach upward, and then in a corrective fashion downward. So the most classic thing that we see in Elliott wave is this 1 through 5 up with an ABC down. And then later into a corrective phase, like you get, you tend to see 3 to 4 impulsive moves upwards, and then with corrections in between, and then you get your larger correction towards the end, can be a 5-wave down, and so these have a lot of different formats to them. But essentially, what's important is, as Brian says, are we seeing some headlines that pull buyers back in, only to have them hit selling pressure and draw it back down, and that is the behavior of an ABC. So we've got our initial drawdown, buyers step back in, we get a little bit of a bounce, we get selling pressure. It usually happens with an anchored volume weighted average price that we can see, anchored to, let's say it's at the top of 3. It generally bumps right in at B and then falls back down to C. So that's what we're going to be on the lookout for here. They all look different, but there's a repetition to this behavior in the market that we see over and over again. And then finally, this is something that that Martin Pring is very big on, and looking at the economic contraction and expansion as a flow. He sections it up into 6 stages, and in the early part where we've got the contraction, we've got a scenario where we've got an overlay of bonds, stocks, and commodities, and we step into bonds earliest in stage 1, and then begin to phase out of bonds, bond buying, by the end of stage 3, which is where we are now. And this is kind of the middle of the road for stock buying, where it favors stocks that of companies that are able to pass inflation, inflationary increases and savings along to their customer base without losing business. So we're looking for companies that fare well as inflation is in a transitionary mode, and then this is the earliest stage in which accumulating commodity exposure tends to benefit. And then as economic stimulus hits and we get into an expansionary, a more expansionary phase in the broader economy, which is a separate cycle from the market itself, this is where it starts to make sense to shed bonds, sell stocks, and then eventually you're inflation sensitive. And so why it's important for me to take risk measures when we see some of these alerts is that these alerts tend to come when we're making a transition from one stage to another, especially a confirmed. And so we want to preserve capital and be prepared to maneuver and reposition into the things that make the most sense as we shift from one cycle to another. So that's in about 10 minutes or so about an overview of why this is important in my mindset as I see some of the signals and alerts that we're faced with. So again, we've got a lot of yellow. Only one is still technically green, and that's very cautionary. So I'm gonna look to be as conservative as possible and go into a defensive posture when I see something like this. So to take a look at our signals one by one, beginning with the 5% drawdown signal. So this is based on the work of, actually let's start with trend. So we'll take a look at the current market trend, and what's important here is that asset funds flow generally from treasuries into equities, then into commodities, and then we see pressure on all of them from the U.S. dollar indexes. The U.S. dollar index starts to do well, and so you'll see a lot of posts now where people are somewhat confused as to why the Dixie U.S. dollar index is down and equities are not faring better and crypto is struggling, because normally you would see that would be a tailwind. If the U.S. dollar pressure was low, we would see equities doing well. But we know that funds flow in an order, and so before equities peak, we generally see the price of bonds peak, and that's what tells us that the movement that we're seeing right now in equities is probably not the end of our bull market, but likely a more corrective action. If the Treasuries price of U.S. Treasuries was down, and we were seeing equities roll over while commodities and gold were doing well, that would suggest to me that we were transitioning into, that we were at the end of that stage 3 on the economic cycle chart and moving probably into a stage 4. So that suggests this is probably more near-term corrective, but it can still be a pretty nasty drawdown. So that's what's important. So Treasuries doing well in the near term. Gold showing the most strength across all time frames. Equities very weak, and U.S. dollar index is weak. And Commodities kind of a mixed message. We've got a little bit of good mixed with a little bit of bad in each time frame. The move in gold typically precedes the move in commodities, so it's just something that we need to keep an eye on. Anytime commodities are outperforming equities to any degree, it's it could suggest pressure into a later stage of the cycle. In the middle of this screen, we have the up-down oscillator, which just keeps track of what percentage of the last 9 days the market was up versus down. We saw an extreme low on the 3rd. Extreme lows don't necessarily coincide with the bottom of a move in the market. We can see that they have in some instances, but we get farther into the past, and we've got we'll start to run into consecutive series of extreme lows. It just tells us that the market's downtrending right now. We might have a near-term exhaustive move that leads to a bounce, but does not necessarily mean that we've seen the bottom. So taking a look at the 5% canary, this is based on the paper that Andrew Thrasher submitted in 2023 and got the Dow Award for. I highly suggest taking a look at it. He's got his back test listed. You can find this at the CMT Association website if you're a member there, or it's available for free on ssrn.com. Just do a search for 5% canary, and you'll see his statistical back test. He's also got one on the a method that he uses for the VIX, and I suggest taking a look at that as well. The relationship between the S&P and the VIX can give a lot of insight into sentiment and helping us to identify what will happen next in trend. So I've coded the 5% indicator into TradingView, and then so the way that this signal works is when the index puts in a new 52-week high, and then we see a 5% drawdown from that 52-week high within 15 trading days, that represents elevated risk. And so it's not the magnitude of change from high to low that signals a more extreme risk to us. It's how quickly we see that change. And so when we make a new 52-week high and we're dropping more than 5% from that 52-week high within 15 trading sessions, essentially 3 weeks, that represents a risk of a more serious shift in market sentiment. But it's an alert and not a trigger for us to take action under the premise of Andrew's paper. And confirmation comes if we see 2 consecutive closing days below the 200-day simple moving average, which is this red line. And so we had this looks like a touch of that trend line, but we'll zoom into it a little bit more, and we can see that it's actually if we convert this to candles, we had the candle wick down below the 200 on Thursday, the 6th, and then open below it on Friday the 7th, wick way below it, right? But when we look at closing price only, which is what we see with a line chart, there's a small gap on Thursday and then a higher close on Friday. So we have not had a close below the 200 yet, only tests of intraday price below the 200. That does not alleviate risk, it just means that we haven't confirmed the initial alert. I like to use the alert on the NASDAQ composite. Andrew's paper does not cover the NASDAQ. I think it's probably more speculative and has a higher average true range, but he used it with the Dow, which is the third one here, and a number of international indexes. So the Dow had a new 52-week high back in November, I think, back in December, and then fell below 5. Had the 5% alert within the 15 sessions, and recently cleared that alert in in February, and the Dow has not been below its 200-day simple moving average. It's still worth keeping an eye on. And if we look at the condition of the major moving averages, we can see price below them. The more accelerated moving averages, the simple 5-day simple moving, 21-day volume weighted moving average, and the 50-day exponential moving average, prices below each. They're all sloped down. The 5 is below the 21 for the S&P. Similar story for the Nasdaq. Of course, the Nasdaq is also below its 200, and then the Dow very similar to the S&P. So clearly shifting from a primary uptrend to a secondary downtrend, and the risk for us is whether or not we're entering a extended downtrend. The next indicator that I look at is for market timing is the McClellan oscillator, and this is a breadth indicator that is a difference of net new highs and new lows each day. This indicator is more of like a market reversal and contrarian trading indicator, and that's why I like to keep it on the list. We'll get many more signals on this one, so you can see, this is the automated back test that I'm doing with TradingView. We've had 95 signals on this indicator, and it's looking at the S&P. I think this is like an all-time indicator. So this one will be looking at an extended time frame for the S&P. Let's see. Yeah, so it's going back to like 07 to pick up a list of trades on it. So what it's telling us is when we get into an extreme state of oversold breadth conditions, and then pull back above that extreme state, it signals an opportunity for a 5-day a bounce higher that we want to cash in on very quickly. But what's important is to know, whether or not we've had extreme oversold conditions from a breadth standpoint, and we came just shy of it on the 4th. So we haven't had that signal. But what's not good is that this means this is more of like an extended type of negative breadth signal. And as of the close on Friday, on our breadth score, we've only got, so this is a composite model of 10 different breadth metrics, and only 2 of them are favorable right now, and they're very long term. So definitely not a good environment for breadth. But the McClellan signal is yellow in the sense that it's below 0, but it is not red in the sense that it has not made an extreme like it did in these prior conditions. The indicator that we have in the middle of this chart is the volatility weighted put-call ratio. And so the ratio of puts to calls can tell us whether the market is favoring risk on versus risk off from a sentiment standpoint. What I'm looking for in this signal is we've got a follow line, which is similar to a Bollinger Band. It's looking at the number of standard deviations away from a moving average that we are. This line's only looking at the relationship to the line itself, and it's a more narrow band of movement that it's measuring. The 2 of these in conjunction give us a very good indicator. You can get a false positive from just one of them by themselves, but the volatility weighted put call ratio is taking the puts and calls. It's applying a rank of the average true range per day, so how much movement we see in the stock price, as well as the put call ratio, and then it's applying like an RSI and a stochastic to smooth it over time, and then applying a Bollinger Band to it. And so when we have an explosive movement of the volatility weighted put call ratio beyond its lower Bollinger Band, that tells us that the market's taking an extreme measure. And when we see that at the same time that we see the follow line change from bullish to bearish, then we've got our confirmation that this signal is telling us that it's risk off. And this is a very high win-loss rate on this signal, and it usually precedes drawdowns in like the 7 to 10% range. It's not been great for predicting like extended drawdowns, and it can miss some major ones. So I would likely have considered this one back here to be, we might have even been enticed to get back into this 2020 drawdown on this signal alone based on the way that the put call ratio bounces. But you can it's not a safe signal by itself, but it'll warn us of some impending 5 to 10% drawdowns. So this one is yellow because the follow line is negative, and we're trending towards that lower Bollinger Band with risk of closing it. On the very bottom, this is a composite momentum model, and it is combining the 21 period RSI of the New York Stock Exchange, so all of the stocks in the NYSE. If that RSI is above 55, it's giving it a score of 1. If it's below 45, it's giving it a negative 1. So it's a very simple 1 through 3 scoring system, and then 0 if it's in between those two figures. It's using a 17 period stochastic of the S&P with a +1 if we're over 65 and a -1 if we're less than 15, and then also using a 14 period stochastic of the Dow with a +1 over 70 and a -1 less than 40. And then we're using a 10 and 20 period simple moving average with it. So I don't use this for the signal, but for confirmation. And when we come off of a low, we'll expect these to, this measure to go positive, and then we'll expect the crossover to follow it. So this is a good follow-through signal once we've seen a recovery from the volatility weighted put call ratio, or even any of the other signals on our list. So this is a good one for near-term volatility. A slower moving signal with a very high win-loss rate is the Fabian market model, and this is looking at the S&P, the Dow, and the Dow Utilities Index, and their relationship to their 39-week moving average. And we can see that the S&P is at risk of, as of Friday's close, coming below this 39-week moving average, but it looks like it might have, it crossed below it. So this one technically is giving us a signal. The indicator's not quite picking it up yet, so it'll probably pick that up on Monday. And then the Dow is Dow Utilities Index is below it, and below it for the second time. So we've got the Dow itself is still above its 39-week moving average. If all three are below, then that's our risk-off signal on the Fabian market model. The nice thing with this is if you're very long-term and you don't want to get whipsawed in the market, this signal doesn't go off very often. We've got 22 going back to 1970. That's not a lot of signals, and so it's keeping us in the primary uptrend for as long as possible and waiting for a lot of confirmation before signaling us to exit. The Fisher-Coppock is, in a similar sense, this one is very slow moving. I'm using this on a 2-week time frame. So the Fisher transform is the area chart behind us that's like this teal color, and it's a little bit choppy even on a 2-week. All right, so what I'm using is a least squares moving average and then a simple moving average of that, and so when the least squares moving average of the Coppock, least squares moving average gives us a line of best fit throughout a choppy data series, and that's why it looks so smooth. When that crosses below our simple moving average, that would give us a yellow signal, and you can see it's super close these last 2 months, And then we've got on the Copic below, the signal as if it falls below zero, and it's still above zero. So technically this one's bullish, though cautionary, because we're using two Copic signals. One is on this 2-week time frame, and one is on a longer time frame, and that's that like much smoother blue line. And so when it's falling below that, it's telling us that the near-term trend is falling below the long-term trend. And so it doesn't give us a signal to act on. It just tells us to be on the lookout. Both of these are technically still in the green right now. So this is our only market timing signal that is still green, and it's so slow moving that, again, this is a very confirmational type of signal to use. Next, we'll take a look at the equity commodity model. So this is a Martin Pring method. The commodities prices are in red, and then the S&P is in black here, and then we've got the momentum of commodities in the middle, and you can see we had an extreme. So back in July of 2022, this is monthly, so again, a very slow moving indicator that we can use on a confirmational basis to tell us whether our outlook should be bullish or bearish. We had an extreme in July for commodities on the momentum side, and then it rolls over its moving average, and that told us that commodities were going to have a little bit of a challenge. But this looks like a really kind of classic cup and handle pattern, and if commodities should break out of this, we would expect to see a pretty large move. But the premise here is that equities and commodities do need to share a trend together over the long term. You typically see equities outperforming commodities, and lower commodity prices can be a tailwind for stocks, but they do we don't want to see them move out ahead of one another or lag too far behind one another. Don't mind my math on this. The way that I put this S&P symbol in, I was trying to filter out trying to filter out a bunch of drawings without deleting them, and just did it a lazy way. So this signal is met if 2 of 3 conditions answer yes. One is if both rates of change. So we've got the rate of change for commodities and the S&P at the bottom. If both of those are below zero, that's a bearish condition. If the spread between the rate of change of commodities and the S&P is greater than 20, then that's a risk signal. And then if the inflation adjusted price of stocks is below its 9-period moving average, then that is also one of the risk signals, and that's the only one that's is signaling a yellow right now. The rest of the other 2 are still green. Looking at the advanced decline line, so the advanced decline line by itself can look a little bit noisy, but what we're doing here is we're dividing the advanced decline line by its 32-week moving average, and then applying a standard Bollinger Band to it. And what we see is when we break below that Bollinger Band, this is just another breadth metric, right? But what happens is an extreme movement below the lower Bollinger Band of the advanced decline line divided by its 32-period moving average tells us that in the majority of these instances we have not seen the low, that there's another downward movement that will follow it, particularly when we've made a new 20-period low. I think it's a 20, maybe a 21-period, 20-period low, and a break below the lower Bollinger Band for the advanced decline line divided by its average. So that tells us that the market has a lot of momentum behind the number of new lows that we're seeing put in, and represents higher risk. And here we've got a cluster of 3 instances where it's falling below that Bollinger Band, all back to back. Sometimes a cluster can signal the low, but again, we're seeing, you know, a series of lower lows in the market in conjunction with it, and that you know, that's what adds the risk for us. Some other times where we've seen, you know, big clusters of them, we went a little bit sideways in 2016, and then, you know, continued to break below. So it's, you never want to see a series of new lows, but this is you know, kind of violently breaking through what would be the norm in the market, and that's our risk signal. There are 2 risk signals on this chart to be aware of. These both come from a Dow Award paper, the 2024 Dow Award paper on the impact of new lows. The first is the one on the bottom is our selling climax, and when we have intraday movements above 4% in net new lows, this is an unsafe environment for new buying, because we're likely to see further drawdown in the market, and these things tend to, you know, it's kind of rare for them to happen in isolation. So it was a red flag when, you know, we started to see this last August and into October, because it's just an anomaly to see, you know, a couple pop up here and there. They tend to happen in clusters, and once, you know, once the trend of these extreme you know, selling events goes away, then we can resume an uptrend. But it's higher risk when we're seeing an elevated level of selling. And then in the middle is extreme vulnerability. This is counting the consecutive number of days that it has been since we have seen an extreme new low in market breadth, in new lows. So if the number of companies making a new low is below like 0.325%, that's an extreme, and it resets this counter down to 0. When we get to 65 sessions, 65 trading days without an extreme new low, the market's at an elevated risk for a deeper drawdown. And you can see this meter can reset, but the fact that it went that high tells us that there's risk on the table, and this is essentially telling us that you know, the market's not putting in extreme new lows. In other words, everything's moving up together. That signals that the market has experienced a change in sentiment, and that we can expect to we're at risk of further drawdown and some of our bigger movements down once we've seen this occur. And it's not, you know, the majority of breadth signals you want to consider to be a condition, and not like a signal is telling us that we want to take action. A condition tells us to be aware of it and manage risk accordingly. So this tells us that there's a risk impending. It doesn't really tell us when we could expect to see it, just that it could be bad, right? And so that's why we're using it in conjunction with other things. This is the longest time frame that we've gone without an extreme in net new lows since 2015. The worst on the board, you know, was you know, nearly 300 days without it in the 2008 drawdown. So this trend that we're looking at today is in the company of the 2008 drawdown, the 2015, which then led into these movements around like the Brexit timeframe in 2016, and you know, then now, right? So we didn't get to one before COVID, right? Because that was an exogenous event that didn't represent a building shift in sentiment, like this has, right? So that's why this one's on here, and this one's been read the longest on our tracker. And then finally, This is a multi-time frame approach, and one of the very first technical analysis methods that I worked with. If you're on Twitter, look for Fibbo Swanee, Brian Swan. He also posts a lot on a lot of his work on TradingView, and very sharp guy. He's who I learned Fibonacci and momentum and trend following from early on in my journey, and I still use his methods in a lot of my approach today. So his method looks at whether the RSI, your relative strength index, is in a bullish zone or a bearish zone, how strong that trend is based on the ADX, which is your average directional index. The ADX tells us whether the white line is your ADX, and it's telling us whether a trend is strong or weak, and whether the strength or weakness is in an exhaustive stance or not. So the kind of bluish background in the middle, this is a sustainable area for a trend. When the ADX is very low, like around a 10, that tells us that it's made an extreme low, and the trend is gonna start to build strength again. And when a trend is when the ADX is very high, above 30, into this like 40-50 range, that tells us that the trend is has been very strong, but it's likely going to run into exhaustion, and we'll see a little bit of a change, not necessarily a reversal, but possibly a pullback after you come off of an extreme. And then within the ADX, you have a directional index. You have positive directional index is this green, and that represents buying. And then the negative directional index represents your selling, and that's the red. And so what we're looking for here is, now what Fibbo would do is he would see a crossover in momentum. He would look at price in reference to prior Fibonacci levels. He would anchor his next Fibonacci tool to the momentum crossover, and then follow it with trend. And I still follow that approach with a couple of other momentum and trend following tools, and I really like the insight that anchoring these things to market transitions can give. But for this model, what I care about is has momentum shifted from bullish to bearish, and on the daily time frame, it has been bearish since mid-December. So we've been in an RSI bear zone since the middle of December. We can see that the negative directional index has routinely been above the positive, and we've trended lower. Though on the daily we've kind of gotten into an exhaustive, but we haven't seen a bounce from it. So this trend picking back up, though, this doesn't tell us that when the ADX is bounced off of a low and comes back up, it doesn't tell us that price is going to reverse. In this case, the negative directional index has gone up above, so it tells us that our downtrend is actually picking up strength, which is not good. And on the weekly side, we've got the negative directional index above the positive directional index. For the first time since the end of 2023, and in doing so with the ADX curling upward, so it's picking up a little bit of momentum on the weekly. The weekly RSI is still bullish. If this flips bearish, then this indicator is red for me. And on the monthly side, this is more conformational and less about execution, but the positive directional index falling below the ADX is always a warning that we're at least in proximity to a near-term trend reversal, and we're just now seeing that on the monthly as of the February monthly close. So that's how the momentum index helps us with trend following. So those are our risk signals. unfortunately, the picture is not very good for us right now, in terms of the outlook for equities, and we'll keep a very close eye on the 5% drawdown indicator. Why this is particularly risky right now is, we've had multiple signals from this in the past, that were not this close to the 200-day simple moving average. So the market making a new high while the 200 was so in such close proximity, puts us at greater risk for this thing to fall below it and fall into a downtrend, a confirmed signal so close to making the alert. The once the alert is signaled, if we go below this 200-day simple moving average within 42 trading days, so roughly 2 months, then that would be our confirmation. So we have until May. This thing has to stay above the 200. If this thing makes 2 consecutive closes below the 200 simple moving average before May, then we'll have a confirmed signal that we would want to take more risk-averse measures against. So that's pretty long. It's about 45 minutes, and I'll do the follow-up on what we would see that would tell us that it's safe to come back in, and then we'll take a look at the VIX signal and a couple things in the crypto space. But I want to thank you guys again for your time and your input, and for anybody who sticks with us sticks with it to the end of a 45-minute video. I really appreciate it, and it means a lot. If you have questions, like I said, please ask, and feel free to reach out. I'm happy to take a deeper dive on any of this, or host another call to walk through it. Thanks.